Startup journeys are very similar to video games with different levels. Each funding stage unlocks new challenges and bigger bosses. Welcome to the VC Decoded post number 3, where I break down how companies evolve from garages to becoming unicorns. Let me walk you through each stage with some real data. Seed stage. The theme of this stage is prove it works. At this stage, you're trying to prove product market fit and early traction. The average is about $6 million pre money valuation, and you're raising about 500,000 to $2 million. Here's a crazy 2025 example. LM Arena, an AI benchmarking tool, raised a $100 million seed round to a $600 million valuation. Now, that's not typical, but it shows how hot AI is right now. Series A, which is the next stage. The theme of this stage is prove it scales. Now you need to prove revenue growth and market expansion. The average is about $45 million pre money valuation, and you're raising about $10 to $20 million in this round. But here's the brutal reality check: only 46% of seed companies ever raise a Series A, and most startups die right here. In 2025, Reflection.ai raised about $130 million in Series A at a $580 million valuation for building autonomous systems. That's way above average. But again, AI companies are getting premium valuations. Series B, which is the next stage. Prove you can dominate is the theme here. At this stage, you are going for market leadership and operational efficiency. The average here is around $100 million pre money valuation, raising $25 to $50 million. Rain, a fintech company, raised $75 million Series B in 2025 for expansion into financial wellness features. The next stage pretty much are very similar, so we'll call them Series C and beyond. The theme of them are prove global dominance. Now it's about international expansion, acquisitions, and IPO preparations. Average valuations are about 200 million plus, and you're raising 50 million or more. Celestial AI raised $250 million Series C at a $2.5 billion valuation this year for AI infrastructure. Now, the brutal math that most people don't talk about is that from seed to Series A, there's a 54% failure rate. From Series A to Series B, only 30% make it. From Series B to Series C, only about 20% of those make it. And from Series C to IPO or exit, there are only about 10% who make it. What changes at each stage? The investors change from angels to VCs to growth funds to PE firms. The focus shifts from product to growth to efficiency to scale. Valuation methods evolve from hope to metrics to comparables to financial models. And team size grows from 5 people to 50 people to 500 to 5,000. Here's a recent trend: late stage companies are raising massive rounds to stay private longer. OpenAI's $40 billion raise shows how Series D and beyond has become a new normal for unicorns avoiding public markets. The pressure and expectations increase dramatically at each stage. Seed investors might be happy with user growth. Series A investors want revenue growth. Series B investors want path to profitability. Series C investors want market dominance. And understanding these stages helps you decode every startup news story and investment decision you read about. Next up in my series, I'll decode valuations, pre money versus post money, and how these numbers are actually calculated. Stay connected and follow me for more such insights. Thank you.